Welcome to MHN Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today we're talking about senior housing development and investment potential. I'm Suzanne Silverman, Editorial Director of Multi-Housing News, and our expert panel today includes Lisa McCracken, Head of Research and Analytics for the National Investment Center, or NIC, Jesse Marinko, CEO of Phoenix Senior Living, Jennifer McGurty, Head of Senior Housing Asset Management for AEW Capital Management, and Charlie Jennings, Chief Development Officer for Harbor Retirement Associates. We're recording this session and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. Don't be shy. And thank you to those of you who did submit them in advance. We'll try to get to as many as we can. We're going to start off with a database presentation from Lisa, and then we'll discuss the issues in more depth. So Lisa, I'll turn things over to you.
Great, thank you, Suzanne. Yeah, so we thought we would start off the webinar today with some data and information. This is a good foundation for the conversation that's going to follow. So we really wanted to cover some of the key, what we call market fundamentals. So what are we seeing in the industry? What's the data telling us in terms of some of the demand, supply, dynamics? What are we seeing in terms of the continued, what I'll call recovery from the pandemic? So I want to start here just with a few takeaways, and then I'll show you the data, the graphs, and the information that is the evidence behind this. So we're starting off 2025 with some very positive momentum, strong tailwinds in the sector. So we did finally at the end of last year hit that milestone of rebounding the occupancy back to that first quarter of 2020. That was a big sort of line in the sand that we were all looking to hit and surpass. So we're at that point, and the occupancy continues to go up. We also continue to have each quarter occupied senior housing units hit new records. So that's the number of individuals that are residing in a senior housing setting. And I'll show you a graph around that. So absorption is strong, demand is strong. There's clearly a lot of tailwinds from the aging demographics, the baby boomers. And at the same time, we definitely are having limited inventory growth. And I know we're going to spend some time talking a little bit more about that. So if we could move on here, I'm just going to talk a little bit about what the specific data points are and what we're seeing this. So what you see in front of you is this is the what we call the NCMAP primary market. So this is the 31 most populated markets in the country, the metropolitan statistical areas. And I will show you some insights into some differences we're seeing in each of those MSAs. But the green line is the occupancy. We obviously know when the pandemic hit. That's that dip that you see there in the green line with the occupancy, as well as the orange line, which is, or the orange bar, which is the absorption. So those are some move outs and clearly a difficult time. But we continue to have, since we plateaued, increasing occupancy. This is occupied senior housing units. So again, this is not necessarily a percentage, but these are people that are living in a senior housing setting. So continue to hit record highs. This is primary markets. If I showed you the secondary markets, it's a very similar trend. So those are certainly tailwinds. And if we move on, you can see as well here those differences by those MSAs that I referenced. There's a lot going on here, so let me just break this down for you. So, the prior data points that I gave, that's the national takeaway and averages. But clearly there's differences depending on whether, what market that you're in. So the key things that are shown here is really the occupancy range, where we are as of the fourth quarter. Just a FYI, the first quarter 2025 data is coming out in a few weeks in early April. But so the blue dot is the fourth quarter 2024 occupancy. On the left-hand side, you can see Boston. That's been one of the most highest occupied metro markets nationally for an extended period of time. And then on the right-hand side, you can see Las Vegas, Houston, and Atlanta. And then compared to where they were 1 year ago, which is the orange dot. So for the most part, we have had pretty significant growth across all of the markets. There's a few that are a little on top of one another. And there's one, you can see Dallas, that actually at the end of 2024 was at the highest occupancy ever since going back to really 2005, since the NCMAP team has been recording this. So we hit that threshold of back to the first quarter of 2020, that pre-pandemic occupancy. but we're not at record highs. But we're pretty bullish in terms of where the occupancy is going to continue to go in subsequent quarters. And a lot of that's driven by what you see here as well. So, while we have strong demand and demographic growth, we have very low inventory growth. What you can see here is really just that year over year. Again, once again, the primary markets, the secondary markets is the same story. So we're in that 1.5%. That's regardless of whether it's a majority independent living property, majority assisted living property. Again, these are national figures. There's a few markets that differ, and I'll show you that in a moment. We did end 2024 with a few more units coming onto the market than 2023, but I will share with you that that's really not necessarily a trend. And we know that because we do track construction starts. So if we want to go on to the next slide, you can see those construction starts. The other thing that we have found in our analysis is that the construction cycle has lengthened. So, there's a number of headwinds around new development, and I know we're going to talk about that with the panel. But, one of the things is once shovels go into the ground, on average, it's around 29 months until we see that residents are moving in, you're opening the doors. And there's a number of reasons behind that. But really, the construction headwinds are a lot of still cost of capital, cost of construction. So we'll spend time diving into that. I referenced that there are some differences across the markets. If you look on the very right-hand side, that's where we ended again, the fourth quarter of 2024. And all the blue represents some pretty little to no construction activity across those 31 markets, with two exceptions. Washington, D.C. I was actually in D.C. last week, and there's a lot going on there. That's one of the unusual markets where there's a lot of development and construction activity, as well as San Jose. They've each responded a little differently in terms of the absorption with that, but generally across the country, there's pretty limited new inventory coming across the market. So that's helping to bolster some of the occupancy rates. We're not going to spend a lot of time on this, but I did want to at least plant the seed for the active adult data. Thus far, I've just really been talking about the senior housing information. So the active adult occupancy definitely is a little higher than what you can see for the senior housing marketplace. So you can see there in the low 90s. It is just very different in terms of even penetration rate. The property counts are around the 700-ish mark, and you can see the average number of units. Most of the inventory is from the last 9 years, but this is one that we're going to pay attention to from an emerging and a growing property type. I mentioned transaction activity. So right now, at the end of the day, a lot of properties can be acquired below replacement costs. So when you look at this construction versus acquisition conversation, that acquisition price is still what's driving it versus, penciling out the new development activity. So 2024 definitely did end with greater volume than 2023. I will note that this data, as of the fourth quarter, we always say it's preliminary. We track closed and not necessarily announced, but we always find that some closed in the fourth quarter prior or after the data release. So that number that you see there for 2024 will go up again in terms of volume. And then this just speaks to a bit of the supply-demand gap and dynamic. So really coming into up through into the pandemic, our development was outpacing where we had the demographic growth. So the 80+ population growth is the orange bar. The senior housing inventory growth rate is that navy blue black bar. And then, but where we started in 2022 and very aggressively moving forward with, you can see on the side, is that demographic growth, which is quite pronounced. Again, at a period of time where we have very little new construction. So this comes from the NICMAP Senior Housing Outlook Report. It has a lot of additional ways that you can look at this. But the bottom line is, with the current pace of development, we anticipate that there's going to be a gap between some of the demand and supply available. And I think that wraps it up for my information. And then I know we're going to dive into some conversation.
Thanks so much, Lisa. This was a really helpful basis for us to get started on. So as Lisa mentioned, we're starting the year with some good news relative to occupancy and demand, which has attracted more interest in the senior housing space. Investment ramped up in the fourth quarter, and there are more people trying to get involved in the space. Jennifer, I'll start with you. Do you see increased interest in development, or is the focus more on investing in existing properties?
Yeah, so maybe this will change in the next 6 to 12 months, roughly. But currently, development deals, they just don't pencil, as Lisa alluded to. So current pricing on existing deals, so we can take maybe some lease up risk for a newer vintage community as opposed to development risk. And we're seeing a discount to replacement cost. That spread has been narrowing. Let's say a year ago, maybe it was 30 to 40%. Now it's probably closer to 20, 25%, but it does still exist and it's real, it's meaningful. I guess we're assuming too in those numbers that our construction cost or replacement cost stays stationary. Probably also not likely with some of the tariffs and policy changes. So I think until there's a change in how we're pricing existing product in the sector and then more clarity on construction costs, it's really tough as an investor to make the case for development right now.
Okay, and Charlie, as Lisa showed us, we are nonetheless very short on inventory, and it's going to become an even bigger issue as more baby boomers aged uh, into the segment. What are the greatest inventory needs right now?
Sure, thank you. We're going to see, the needs increase obviously across the continuum, but I think the things that obviously that have driven our industry since its inception and will going forward is the higher acuity, assisted living, memory care, the level of care that people just need that's really hard to replicate even in your own home. We talk about the activities of daily living. There's a lot of ways to support that in the home, but socialization and interacting with your peer group is something that's very hard to replicate in a home environment. And the reverse of being blessed to age in our nation is eventually you get to a point where it's hard to take care of yourself, and that's a reality of where we are. And I think that's with 71 million baby boomers. Obviously, the older you get, the more likely you're going to be impacted. I think the latest number I saw was if you live to the age of 85, you have a 50% chance of being diagnosed with some form of dementia in your life. It's just a huge number of people that are going to be needing our services. And I said, hopefully we'll continue to increase our penetration rates as an industry. So people are looking at active adult and independent living earlier in their lives. But reality is right now we're seeing the age of our residents coming in, the acuity level coming in is higher than it's ever been. We're serving, our average age in assisted living is probably now 86 years old. So and the average stay is gone from 2 years to probably a year and a half. So we are serving a more frail industry or a frail customer base, and we're going to see that continue for the next 20 years.
Yeah.
So
do you mind if I add on to that, Susan?
Please
Just
do.
To your point, Charlie, I think it's interesting to know as we look ahead and we talk about the need, there's the demographics and you reference the acuity and so forth. One thing to keep in mind, there's some really unique characteristics of the boomer population that are really going to be advancing that need too. So the divorce rate among the boomer population has tripled. The divorce, it's like 40% of divorces right now are 55 people, couples 55 and older. Yeah. And I say that because it's often the spouse that might be a caregiver if somebody's health starts to decline. So that safety net's less likely to be there. The percentage of boomers with 0 children is also significant. So, we know overall as a country, our fertility rate and birth rate continues to drop, but those those impact our sector just from a demand and what the need is going to be standpoint. So I just wanted to reference that, just reinforcing that there's some natural things at play here that are going to, I think, layer over top of some of these acuity needs and reinforce, I think, what we're doing and offering as a sector.
Yeah.
Those are good points. Thank you. So we need more housing. We need to figure out how to make it happen. Jennifer listed a few of the challenges right now with construction costs and the spread narrowing, but not quite there yet. What are other challenges that we should address, and then we'll get into some of them on a more in-depth basis. Charlie, since you
Sure.
were just talking, maybe.
Yeah,
first.
and I think at least from my perspective, or what we're seeing across operations, construction, development, labor is the common core. That's the common issue across not just our industry, but most industries now. I think the lingering impact of the labor disruption had much more of an impact on our industry than COVID did. You know, trying to be, and you're seeing a lot of emerging technologies and ways of trying to increase the efficiency of our labor pool, because it's very hard to get labor now. We all know that. We saw our costs go up, our expenses go up, our valuations go down as a result. We're climbing out of that, as Lisa mentioned. So, you know, I think better days are ahead. But it will continue to hold us back. We can only provide, you know, we talk about technology a lot, and we're all looking at new technologies that hopefully will make us better. But our chairman likes to say our business at its core is 1,000 transactions or thousands of transactions that happen each day where one person is laying hands on another. It is a caring, you know, it's a caregiving industry. You can be better, you can be more efficient with technology, but you can't replicate people. People will always be at the center of everything we do. And so from an operational standpoint, it is still our biggest challenge, and I think will continue to be. Not to dig too deep down at the construction side, but if you talk to people on that side, you'll find that that's also their biggest challenge. You know, commodity pricing for materials, it fluctuates. Obviously, there's a lot of unknowns about tariffs and things like that. But that is their biggest challenge. The latest statistic I saw was for every 4 people who leave the construction industry, 1 enters. So, you know, it's going to continue to hold us back because their costs are rising, because they're having to pay more for the people that they can find. So I think labor is going to be our biggest challenge on both sides.
Anybody else have anything to add to that? Jesse, Lisa?
I think Charlie hit it pretty well. Labor has been an issue in our industry since inception.
Yeah.
So for us, it's just the exacerbation of the focus on it. Obviously, we see a lot of nursing shortages and caregiver shortages. That's probably hits us the most. You know, and then the challenges are just the things that, you know, Jennifer and us and Charlie will all articulate through the call, which is just the capital markets as well.
Yeah.
You know, the current debt and cost of construction, and then you layer in the transactions that are getting done are at replacement costs that don't really make sense to go develop out there. So we've got a lot of factors all in front of us that are affecting growing a needed supply increase.
Yeah.
So very, very challenging.
Yeah, the only other thing that I would add, and this isn't an easy fix either, but I think, you know, one of the things that is added to the length of the construction cycle, the labor is definitely a big part of it. You know, for all those skilled laborers that are retiring, the new ones coming in, it maybe takes a little longer. They just don't have the legacy. So we definitely are hearing that. But even just I think the red tape and the approval process has gotten much more difficult. So we are definitely hearing that. You know, sort of like this last mile. You maybe have the construction done, but you're just waiting on all these approvals, and time is money. So I think, you know, there's some things that if and some of it's obviously all can be incredibly local. So I think if you can remedy some of that and shave off some of the development cycle, you know, that could certainly help. But I think the markets that are incredibly high barriers to entry from some of that approval, regulatory red tape stuff, I think are probably going to be hurt the most, quite frankly, from what's available for the seniors in those markets.
Couple more months of carry costs, they hurt.
Yeah.
It's a lot of challenges up in front of us to overcome.
Yeah, I don't think any of us thought, like, we've been talking about the boomers forever, right? And
yeah,
they're on our doorstep, and oh my gosh, we're in this very strange environment. You know, and again, we still have, you know, some wiggle room. It's not like we're sitting at 98% occupancy as a sector, but yet, you know, you decide to do something today, it doesn't come on the market tomorrow. So it's going to be a very interesting couple of years on the supply demand side of things.
Yeah, well, and as Charlie mentioned, there's a big operational labor shortage. There's a big nursing shortage in this country right now. Lisa, how much is that holding back inventory growth? I mean, if you can deliver properties, can they be operated now, or
Right.
how much leeway is there even?
So I think, you know, I feel like if the other things would align, the construction and the capital, people would be moving forward with some of the development. I'm not saying the labor stuff is easy to figure out, but figure it out. You know, it is a high touch environment, but you know, where can some of those technologies sort of honestly help the staff to be more high touch? Because right now, sometimes from a staffing standpoint, we're doing, you know, paperwork or whatever.
Yeah.
I would just comment more on probably the how it's shifting, how we're growing as a sector. And what I'm going to equate to is the decline we're seeing on the skilled nursing side of things. Every week that goes by, we see fewer nursing homes, fewer nursing beds. There's a whole variety of reasons for that. But if you overlay that with the trends on assisted living, they've been going up. So we've been seeing a bit of this shift in terms of increasing number of assisted living units and communities and properties and decline on the nursing. I think labor is more in play there. And of course, you need direct care staff on the assisted living side of things. So I think it's definitely impacting how our sector is growing. Is it limiting new development? I haven't heard anybody say, you know, we've got the capital and we got the construction partner and the land and we want to develop, but we can't because of the nursing shortages.
Yeah.
You know, but you know, it's part of the feasibility conversation. You go in and you look at a market and are the demographics there, is the demand there, but is the staffing there? So I think the feasibility conversations definitely, you know, are more likely to look at labor today than, you know, those studies did 10, 15 years ago. That's what I would say on that front. I don't know if others agree or disagree with that.
Yeah, I think the labor challenges also affect, you know, when we do start building again, what markets we're willing to go into, right? I mean, you know, it costs the same to operate a community, assisted living memory care community, you know, so you really want to, you know, from an investor standpoint, you want to go into the markets where you know you're going to make up for that on the revenue side. So I think, you know, I think that will definitely impact, you know, where the construction might kind of start when it all starts again.
Yeah, to quantify exactly what Lisa and Susan are alluding to, through 2033, there's an estimated need of 821,000 jobs just for healthcare relation. So the need is going to continue to grow and be there, right? And we're aware of that. But to Lisa's point, you know, as Charlie and I have sat down and had capital conversations, very rarely is that going to be, is local labor from an operations side a reason you're going to do or not do a deal. I think Jen's point is very valid, that, you know, where you're going to grow or maybe create more communities within a market is based on the data sets you have. But most time when you go down for a development, you know, you're focusing on the higher risk factors that are within your path, within the development process and construction.
Okay. Well, let's talk about some of the financing challenges and the financing opportunities as well. And Jennifer, I guess I'll throw the first question at you. What types of capital are active now, both on the debt and equity side, and how is that changing?
Yep. So the REIT's very active, very significant right now. Private equity as well, obviously. I think we actually have a couple of sales processes kicking off now. Definitely some new faces that we're seeing on the private equity side. So that's always good. Debt, I would say there's 4 key groups that are actively lending in the market. So agencies, regional banks, insurance companies, and debt funds. And while large commercial banks, they've been pretty quiet lately, we are starting to see early signs of renewed activity. So that's good, which shows some confidence in the sector starting to return. And then debt funds and regional banks, they appear to be expanding their exposure and looking for to be more active in the sector. So that's also good to see that increased appetite.
Anybody have anything to add? Or did she do a good summary there?
Yeah, no, that's great. And I think we're all hopeful, not to get political at all, but I hope we're all hopeful that we're going to see a little less regulation on the banking side, which has also been holding things back. So that, you know, hopefully that will allow capital to start flowing a little bit easier too.
Mm-hmm.
Yeah.
I think Jen nailed it. I think that's who we're seeing out there in the market. I will say debt funds are definitely growing their presence, because I think the compression between a regional bank and a debt fund is not that far right now. So I think it's been interesting to watch how debt funds have helped open up the landscape, and then people getting used to that higher cost of capital, which I think ongoing, it's an interesting conversation. I think we're going to have to get used to a new norm, even when things get better. I think
Mhm.
it's going to then as well put a potential additional constraint on projects underwriting or papering,
That's
because I
right.
think the debt numbers are going to have to be probably more realistic to long term, trending, if you will.
Um, and I'll just add on a couple additional ones. So in terms of there's two things I think that are behind some of this capital, what I'll say momentum or expansion. So, we do see some new folks, whether it's new funds coming in or whatever, but there are
Mhm.
some growing investors where they're already making some investments in our space, but are looking more closely, and they tend to be some of the longer term investment, pension funds. We know are increasingly looking and investing in our space. Family offices, the number of family offices in general has just grown exponentially. And, a number of them are really looking at the alignment of senior housing and sort of some of their investment objectives. So I think we're pretty excited to see some growing interest on those fronts. And I know on the Nick side of things, we're talking more and more to those audiences. The other thing I think it's worth calling attention to is really just even around a conversation of allocations. So if you are, you're investing a certain amount in, commercial real estate investments and so forth, there's just a lot of shifting, I think, that's going on right now, or say, okay, well, maybe in the past we didn't have as much on the senior housing side of things. We're going to move away from either multifamily and do a little more in seniors. We're definitely not dumping money in office space right now. So it's some of it is just sort of, again, some of that shifting landscape. And the senior housing has gotten more visibility on some of these, in the investment landscape, in terms of particularly being called out with the NCREIF index. So that's the National Council for Real Estate Investment Fiduciaries, where senior housing prior to 2024 was always just lumped in this other category. It's like the hodgepodge of everybody else. We are now a separate standalone category as part of that MPI index. And that really helps often justify some of these investments. So those are some really positive tailwinds, I think, that help us on the capital side of things that are worth acknowledging.
Good thoughts. Jesse, can you take us through what it takes to get underwriting now, and what kind of limitations there are on properties that can be underwritten?
Yeah. It's been an interesting environment from the underwriting perspective. Obviously, I think when you look at deals today, you probably look at what can go wrong versus always focusing on the upside based on the past 4 years we've kind of come out of.
Mhm.
So the underwriting process, I think, is getting kind of a different lens. I think the appetite for turnaround projects or projects that are going to need some sort of runway to get to a justification evaluation are just not getting done right now. The capital markets, as you're looking down and seeing what type of projects are appealing to capital right now, it's typically things that are 10 years or less and are cash flowing. Anything else is kind of getting, I'd say, just not a lot of looks or not a lot of attention, for a whole host of reasons, whether the most funds or groups probably still have a decent smattering of that type of product already in their portfolio that they're working through themselves. And so as you go through underwriting, you really have to look at, if you're going to do the newer stuff, you're probably going to be in there with a lot of aggressive bidders, and ones with a lot of powder. If you are looking at that other product, the underwriting, you've got to have a pretty clear story on how you're going to change this product all the way around. It's got to be a repositioning. You saying you're taking a product and you're just going to make it better as the same product just doesn't really get past credit committee, doesn't get very far. So as you're underwriting and you're going through that process, I think you've got to be realistic with the trending and the numbers. Lisa made a comment earlier, construction projects, no matter what someone's saying, are 29 months. And so do you put in 32? And lease up that you used to write to 18 to 24 probably is more like 28 to 32 now. I think you're just taking a lot of, I jokingly say we're all wearing our scars, even in underwriting, of what we just kind of went through for the past 4 or 5 years. And so I think that underwriting process has just made everyone a little bit keener. I think rather than stabilization being underwritten at 92, 93 back in the past, I think you're starting to see a lot more underwritings come in at 89, 90. And, you know, the good news is the data all leads to, we will see higher occupancies. I think long-term be a stabilized average, but as of today, I just think you're getting a much finer detail lens as you get into the underwriting and looking at that. I'm sure Jen and them can add some color to that as well.
Yeah, I'd say, you know, what gets our attention, you know, I guess right now we're looking at, like, call it a, you know, mid-teens return, something core-like attributes, so newer vintage, supply constrained markets. And, you know, as we've been mentioning, the spread to replacement cost is still important. That's all kind of looking like good entry points for us. You know, and we're, like I said, we're comfortable taking some lease up risk, especially in markets where we feel like we can really, you know, we see a growth in revenue or RevPOR. We feel pretty good about that. We'd go in and do some refreshes as well. If something's maybe, you know, kind of 7, 8 years old, just kind of needs a facelift, we'll do that as well. So I think that's pretty much, I think, where we're focused right now.
And Jennifer, what are you currently seeing as investors' return expectations?
I will caveat this with, it depends, but if I have to generalize, so core plus, unlevered 8 to 10, you know, more value add capital, mid-teens. I'm not sure that's what else is seeing, but yeah.
Yeah. I think that's an important thing that Lisa mentioned about the nature of the capital in our business. You know, if you've been around for a long time, you know, a lot of institutional capital really drove our business in the beginning. And, you know, we saw private equity, nothing against private equity. We love their money too. But they made a big push into our space, and, you know, particularly leading up to the pandemic. And if you were looking at a 5-year in and out, and you got stuck in the middle of that, that's hard. That's a difficult business to be in if you're new to it and expecting to get in and out. And we like patient capital. I mean, patient capital that really goes to the extra length to understand our business, the ups and downs, the challenges of it have traditionally been our best partners.
Mm-hmm.
Good to see them coming back. Yeah.
Yeah. To caveat what Charlie said, I think for all of us who have gone through the past 3 or 4 years, I think we definitely have an appreciation for those capital partners who worked with us through difficult lease ups, you know, those goalposts continuing to move as financing and refinancings and extensions had to occur. And rates obviously were much different than call it 2019, 2020. So I think Charlie hit a really, really important part. As operators and as developers, I would say we are probably really making sure we understand what that new firm or that partner's investment thesis and strategy is, and not just saying, oh, well, it's kind of near what we want. I mean, if you're not a senior housing person, I think we need a pretty good narrative behind that, because we're really, this space is a long-term growth trajectory space. And I think those partners are just key to making it through projects like these that have such diversity. You've got a restaurant, a home care, and a hotel all under one roof. I mean, it's 3 businesses all evolving together. So it's really dynamic, and it takes an owner that understands that, or a partner.
Yeah.
I agree. And I think one of the advantages that we've had kind of going through all of this is kind of understanding and being in the sector a while. And it is funny when you're trying to get a new group up to speed, and just, you know, give you a lot to get your arms around. Like, was NOI this 1 month and now it's this, and my occupancy's moving around, and it's a lot to take in. So I think it definitely helps when, you know, groups are aligned and kind of understand the sector dynamics as well.
Yeah.
Go ahead.
No, I was just a little bit of a ditto. I mean, I know at Nick, we're really trying to provide some resources too, just around some of the education. You know, it's great to have some new folks looking, you know, to invest in the space and new capital, but yet it's way more complex than other commercial real estate property types.
Yeah.
So, you know, it doesn't benefit anybody at all for somebody to come in for a couple of years, have things blow up because they didn't do their homework up front, and then leave. So, you know, definitely I think that education piece and having them understand, the great opportunities in our space, but what they need to do to educate themselves on to make smart investment decisions, and the alignment, you know, what Jesse talked about. I think that's incredibly important between the operator and the capital partner, for sure.
And Jennifer, maybe what I should have asked is, are investors looking for realistic return expectations?
It's a loaded gun question.
Yeah.
And Lisa was already alluding to this too, right? So there's some new capital coming in, right? So now we're part of the NPI, right? So Odyssey funds and core funds are, they were maybe thinking about it before everything happened with COVID, and now they're taking another look. And if you look across real estate, I mean, seniors is one of the most attractive growth opportunities, but you also have to be comfortable underwriting that growth, right? And so, I know in our portfolio, we saw, mid to high teen NOI growth on same store stabilized last year, and more double digit NOI growth this year. And you have to be comfortable underwriting that. And I think that it's kind of eye popping to some groups trying to get comfortable with the sector and having to underwrite that much growth. So that's another thing that we've been seeing.
Charlie, what are the types of properties that are offering the greatest opportunity or ROI potential, and what are you steering away from?
Yeah, I think the ones that we're seeing, both in terms of operationally and financially performing, as well as sort of the appeal to the capital markets, are more of a congregate setting, IL, AL, memory care, where there's a lot more opportunity for aging in place. You have a varying, product that you can offer the, adult daughter who's, the primary influencer in a lot of these decisions. She can see or envision her mom or dad living in that community and being, socially engaged, and, nutritious dining opportunities and lots of life enrichment. As well as knowing the comfort of, as mom or dad's care needs change over the years, they don't have to move again. The first move is a terrible experience for most families. When someone finally reaches a point where they're compelled to leave their house where they raised their kids for the last 40 years and to give up all their possessions, that's an emotionally challenging experience at the best. And the more we can lessen that trauma as they age through the continuum, it also gives us the best operational efficiency when it comes to leveraging our greatest asset, which is our people, like we've been talking about. We're seeing NOIs in some of our independent AL memory care communities back in the 40s, which we didn't think we would see again as recently as 2 or 3 years ago. It just gives you an opportunity to do more with the people that you have and appeal to a greater audience. So that will be our primary focus. It is now and likely will be for at least, for the next few years, I think. I think on the same note, we will likely stay away from any standalone product that's either a standalone memory care, standalone AL, or in some cases even standalone IL, for the same reason, because you're sort of appealing to a very narrow bandwidth, and it's hard to to age in place when your care needs evolve or change. So that's us. I think that's certainly the direction we've been on, and will likely continue on for the foreseeable future.
And we are closing in on time because we are going to be starting Q&A soon. So if you haven't gotten your questions in and you've got some, please do put them in that Q&A window available at the bottom of your screen. Jesse, I did want to ask a little bit about the limitations due to construction and material costs and how that's impacting what you're able to pursue, whether it's types of properties or even the features that you can include, or the size of the properties. What is the impact of the construction cost challenges we've been having on that?
Yeah, no, I think as you look at any development, I think this even really started in 18 and 19 as we started to watch construction pricing jump. I think you started to watch building efficiency become a number that you stare at, that you used to not look at, which is a number that measures the amount of rentable square footage versus the amount of non-revenue generating square footage. So, properties became very efficient very fast. As operators, we tend to look at the thing through quality, employees, customer experience, things like that. So we could very quickly be convinced on why you need an additional amenity space, why we just don't want a multi-purpose room, why we might spread a lot of amenities on second, third, and fourth floor so they don't just feel like hallways and rooms. But as construction costs come up, you've got to get more efficient with your spaces. And then you got to start to think about, okay, do we have to follow more of a hotel level style of design where you've kind of got a core with a lot of activities and a hub and a network that you are able to provide socialization within? And then maybe, look at building, unit sizes, building sizes, square footages. You really start to get into the details of even unit layouts. How do you maximize that? And so I think for a whole host of reasons, we've had to look, I think, a little bit more fine-tuned with the project to try to bring project costs down. And then I think one of the biggest impacts it's made is really, unless you can achieve a pretty good rate within the market, it's almost impossible right now to get a development deal done. You've got to really be in the upper quartile, call it 25%, and Lisa can comment to this, to even be in the running for a development deal right now. Ground up development for middle market, nobody solved that. At this point, that's pretty much going to be a regional repositioning play by an owner operator. That's where that fit's going to have to fit in right now, or something along that volition. It's going to be really hard to pay for construction debt at a middle market rate today. And so a lot of those factors come in. And I think, as we fall in love with the movie theaters and the third hair salon and the yoga studio next to the gym, I think you start to look to say, that gym and yoga studio could be one. That library and sensory room and artist room, maybe that could be 2 rooms. Yeah. I think you start to think about that, but it's interesting. There's a couple of spaces that are just non-negotiables. I think a recent study just came out that of IL product, and I believe it was produced by Asha with some help from Promatura, was around the newest consumer. One of the biggest things they're looking for is still the dining program, still one of the tops up there in the thing. And so while you do that, you look at that and you say, all right, there's a non-negotiable. We can't touch it. If anything, we actually have to make it better. And that might be within a smaller space, but now you maybe spend more cost per square foot on the finish work there. So it's not just a one-way thing. I think you try to still always make sure you understand what's most important to that consumer. I'll let Lisa and Charlie and them comment further.
Yeah, so many things you were talking about. I'm thinking, but there's this tension between what it costs to build, what maybe that checks all the boxes of what the customer wants, because there are, it's not that it's all an amenities, race or whatever, but when people can stay in their home and access more and more, we live in this sort of Uber-like on-demand society. What is going to be our differentiator, and for those that have the certainly the ability to pay. So I think it's this tension between how much it costs to develop something, and then like how much you would need to charge, and what's the market going to tolerate. So you could do developments now, but what you're going to have to charge is incredibly high. So I think if you've got the right capital partner, and you can bring a new development to the market, and you're in a market that will tolerate a very high end monthly rent, you may be successful. But the one thing I do worry about, and we referenced middle market and affordability, I think there's been some pricing power on the rent side of things, and some of that growth and ability to pass off the increased cost to us, to the resident and so forth. But, I think sometimes we move a little further and further away from that middle income senior. And we do have middle income seniors living in our communities now. So it's not to say it's an all or nothing thing, but if development costs aren't penciling out now for the private pay, higher income folks, it's really hard to make that for middle market. So the ones that we see happening are, I think we've made some incremental progress, but they're all sort of one-off stories of how they got done. Where we need to start to see is we need to see a solution that we can scale and replicate. And the independent living is going to be the easy side of things. Once people start to need care, middle income assisted living outside of the assisted living Medicaid waiver is just tricky. So I think at the end of the day, on that side of things, there's got to be some type of a private public type of partnership incentive. So that is a thing we definitely worry about on the middle income, and we continue to try to chip away at solutions. But if I had it all figured out in the magic wand, we'd be in a different place right now. It's not for lack of desire.
There's usually tax credits or some other subsidy involved just to make it work, and those are few and far between. So it is a challenge.
And come with their own headaches.
And then they come with their own headaches.
Yeah, the tax credits are out there, and some people talk about opportunity zones. I'm not sure. You know, there's some projects that have gotten done with those. Again, I don't think that's the magic, solution either.
No.
Okay, well, I could keep going with this, but I do want to answer some of the audience's many questions. So let's jump into some of those. And if anybody's got more, I know I said many, but please ask away, and we'll address as many topics as we can. And if we don't, we will address them in future discussions or future articles. We definitely want to be providing some ideas and some answers to what you're dealing with out there. Well, I guess this is a current one right now because it's about tariffs and how that's going to affect materials costs. And this person is wondering if you have somebody on your team devoted to keeping up with developments at the federal level. How closely are you watching what's going on at the federal level and how it impacts you?
We do not have anyone other than myself, just, staying apprised of as much information as I can, but we don't have anyone dedicated. If we were doing more development, we likely would. We'd be watching it even closer. Jesse he has more going on the development front. He may be watching it a little bit more closely.
Yeah, I think very much like Charlie, it'd be hard to dedicate some entire resource to that. And also, all you got to do is wait a week and the news will change.
Yeah, you'll be
An
chasing
hour.
your tail.
It'd almost be like a stock market analyst job. But no, we are aware of that. Candidly, I think with the contraction and expansion of costs, I think it's all kind of still relatively eased out, because at the end of the day, even construction materials operate on the supply demand curve, right? And with construction being down, while it might be down in our sector, there's data centers being thrown up everywhere in the country right now. Industrial's back in a boom. So the activity just pivots sectors. So I don't think, while I think the tariffs will have an impact, candidly, that's on a contractor and your setup within your development agreement to manage that. And that's really the risk the contractor has to be aware of. I think the way we as developers measure that is just through active pricing exercises with GCs, and then leveling out those numbers to say, okay, here's where we're potentially seeing it. So we are aware. Obviously, we watch materials and watch the news, but we don't have anybody dedicated to it.
Staying with the federal level, we have a bridge lender providing subordinate capital to CRE, focusing on bridge to HUD and construction to HUD, who is wondering about lobbying the new administration in Washington and Congress for waiving the 3-year stabilization. I don't know if that's something anyone wants to touch.
Yeah, good luck getting anyone's attention.
Yeah, there's a lot of
It
issues
sounds like a
out
great
there
idea,
right now.
but yeah, and Asha Argento, maybe, they obviously have, and Nick have lobbying sides to their organizations that I'm sure are actively trying to lobby for attention, but I think it's a challenge right now. I think they've got their focus on other things.
Yeah.
Yeah, understatement.
Yeah. Going back to that whole public-private question, which Lisa, you had just touched on. We have somebody asking, as the public housing for seniors becomes neglected due to lack of funds to maintain the aging buildings, and as higher level funding decreases, how do states and cities plan for the influx of baby boomers? What have you heard at the more municipal level or state level about any kinds of partnership possibilities?
I mean, at the federal level, on the affordable side of things, that's where, a lot of that government funding comes in, with the HUD, and there's, there's been some money behind that, but, I think some of that is in flux and questionable right now too. I'm not, and a lot of this stuff's going to get pushed down, I think, to the states. and a lot of the states are feeling like, hey, they're just not, you know, they don't have all this extra cash around either. So, I'm not sure there's a consistent trend there, I think, to even comment on with that. But, you know, we haven't really talked about that aging inventory, you know, whether it's on the affordable housing side of things, but with the private pay. I mean, the private pay senior housing, about like 50% of the inventory that's out there is 25 years or older. Now, just because it's older doesn't mean it's fallen apart and has physical plan issues. But if it hasn't been reinvested in like at all during that time frame, then, you know, I think there's some challenges to that. I think some of those more dated communities are probably being sheltered a little bit right now because of the supply demand imbalance. But I think once that starts to shift, I think that segment of communities are going to be, I think, a little more challenged right now. But you know, as it relates to the capital and investment side of things, I'm not sure I see the government coming in to save the day on that front, to be honest with you. I think it's going to rely on private capital to do that.
Yeah, if anything, I think it's been the opposite, that the states are putting more on private developers in terms of affordability requirements. I know Massachusetts has one, New Jersey has one. You can't even get a deal approved unless you're contributing, you know, 10 or designate 10-15% of your apartments as Medicaid eligible. So they're putting it on private developers because I don't think they know they don't have the answers inside government. So they figure, hey, we'll put it on the developers to figure it out.
Well, I mean, it's no different than sewer impact fees or whatever. They're going to, you know, we're going to build the city's infrastructure. And I guarantee you the cities, states, and federal government are saying there's such a demand need for seniors. The private sector is going to figure this out for us. We ain't going to spend the money.
That's true.
Well, you mentioned that we haven't gotten into redevelopment yet, and we do have a question on redevelopment and what the opportunities are there. Or I know we had some discussions during our planning meeting about whether it's something that there could be a benefit to pursuing or not. What are your thoughts on that?
I certainly do. And I think a lot of it goes back to the changing demographic that we're looking at. I mean, the customer base that we've served primarily for the past 25, 30 years, you know, the silent generation was actually very compliant in a senior living environment. You know, they were savers all of their life. They weren't spenders. They liked consistency. They liked going to the same restaurant every time they went out. They knew the wait staff. They ordered the same thing. It was what, you know, comfort was everything to them. Their children are so dramatically different. The baby boomers are so different. Every time they go out, they want to go to a different restaurant, a different theme, different music, different cuisine. It shows up in the way they've lived their lives, and it certainly is showing up for the baby boomers we're serving now. They want something different. And if you can't offer it to them, they'll go find it somewhere else. And we do have assets out there, and Lisa made a good point. Not every 25-year-old asset is you know, no longer appropriate for senior living. But if you've got one dining room and no opportunity to add to it, and you don't have a lot of opportunity for programming space, you're going to really struggle to appeal to the baby boomers who expect a lot of variety and choice in how they live their daily living, their daily lives. They want all of the things that they get now, and they want you to provide them for them, or they'll stay home because they have the affluence to do that. And I think some of these assets do have to be a part of the solving that middle market where you can't go out and build something purpose built. It's just too hard. So that's just my opinion, but I think at least that's what I'm seeing.
The one redevelopment thing that I think it's just interesting to throw out there, because you're seeing some of it too, is, all right, where are there sort of conversion opportunities and so forth? And the examples I'm going to give are more on definitely the private pay market rate and maybe not so much the middle market, but we are seeing some of this mixed use with the retail spaces and so forth and it gets to what you're talking about, Charlie, too. You know, maybe there's naturally already, so, you know, restaurants around there. And so a lot of it's location, you know, that built-in infrastructure. So we're seeing some of this mixed use redevelopment of some of these retail spaces where they've got an age, you know, segregated component and development to it. So it'll be interesting to watch some of those. Some of these are the big mall redevelopments, you know, and all this property, and they're taking segments of it and creating some pretty vibrant markets. And I'm seeing both independent living, you some active adult. I know we did talk about that a whole lot here, but and even some assisted living. The active adult lends itself to that because generally those models, strip away the dining, cutting back FTEs. If you build them in certain markets that have that naturally surrounding you, I think that can be a win-win. The one thing that, on the redevelopment side of things that there's a lot to talk about is the office conversion. I haven't heard anybody that says that those numbers work on that. I just think, frankly, it's probably cheaper to build new than to
Yeah.
it's, just with the plumbing and the infrastructure and the design and the needs that you need on senior housing does really not align with I'm not saying there aren't examples that have folks that have done it, but I think that's a stretch on those
Yeah, I think redevelopment is going to be a huge opportunity for us because there's not a lot of attention right now to this older product. And I think over time, there's going to be some stuff that got overbuilt or we're going to have building obsolescence. I know we're currently in a redevelopment of a former AL memory care into an active adult property that will open here in a North Atlanta market here in June. But again, that process took a building getting down to a basis that made sense to allow us to be able to make those investments in redevelopment. So ultimately, at the end of the day, the level of basis or your basis of what you're going to be able to buy is going to allow your latitude, how far left on the continuum you can pull that thing back if you want to. Because most of our product, as we all know today, is really an evolution. And a lot of these buildings that are now older started out as senior apartments, and then they got converted to an IL memory care, and then it became an AL memory care, and then they are what they are today. So I think redevelopment is actually going to be a huge swath of opportunity over the next 4 to 5 years, but they are all going to have to be very market niche micro plays. I don't know if that's a scalable play.
Yeah. And we haven't even touched on all the studio apartments that are out there.
Oh Lord,
nationwide. That
falling out of favor.
I mean, the idea that you're going to convince an 85-year-old person who hasn't slept on a twin bed in a studio apartment since they were in college to give up everything to move into a senior living, unless they have no choice. Obviously, if they don't have any choice, that's one thing, but that's a tough sell. And there are hundreds of thousands of studio apartments out there in senior living right now that people can't give away. And that's going to have to be part of the plan going forward.
The redevelopment and conversion plan. Yeah.
Some
More
success, maybe if you can kind of combine units but it has to be the right building and the right number of units to have that make sense.
Yeah. Well, Lisa, you mentioned independent living, and we do have a question on that too. What do you see as the current outlook for 55 plus independent living communities, including to bring it into senior housing, partnering with continuum of care communities to share resources and promote more development? Do you see it working as part of that?
So a couple things, just in terms of definition, I just share this in terms of how I'm going to answer this. So the 55 plus active adult, that rental, so that's not the active adult for purchase a home. So it's the rental active adult is a different segment than independent living. Independent living generally has the meals, a little more support. The price point's about 40% higher than active adult. Is there an opportunity to align maybe an active adult offering with an independent living and a continuum? There are some that do that. I know there's the debate in terms of, today's active adult, yesterday's independent living. Is it today's independent living, yesterday's assisted living? So, and data has shown that some of the consumer data that they are distinct customer segments. So I think if done right, you can, I know there's developments out there that have both active adult and independent living on the same campus, but you've got to be smart in terms of who your customer is and who you're selling to. So not to cannibalize one another and confuse the heck out of, your prospective residents and so forth. So I think that there's opportunities. Do we see a lot? Not so much. Again, the active adult space is still emerging and growing, but generally those are sort of separate, freestanding, distinct properties as opposed to just, maybe an additional, offering on the same campus. But there's exceptions to that. I think it's going to be interesting to see where we go, because there's some active adult that are very high-end lifestyle focused, some that are more middle market, some that are wellness prevention integrated to it. And so they're each a little bit different too.
Okay. I guess we are just about out of time. Can I get some last thoughts from each of you about how you see the industry changing in the future and what you're most excited about looking forward? Let's end on a high note.
I'll start. Despite the challenges that we have, we are seeing a lot of successes. I think our occupancy and NOI is the best it's been in years. It's improving each month. So there's a lot of really good things happening in our industry, a lot of reasons to be optimistic. I'm excited about this next sort of development phase that I know is coming. It's probably not coming as fast as I'd like it to, but I think we're going to reach a whole new product. A customer base in this country that has never really interacted with senior living and seen what we're all about. And I think we're providing a pretty compelling product. So I'm excited. I think greater days are ahead.
Yep, I'll add on, and I feel like we talked a lot about the headwinds, so not we're trying to be like Debbie Downer. But yeah, I think that there's great momentum, and I think in our observations, I think it's keeping in mind that, you know, this period of lower development, I think, has allowed us as a sector to sit back and say, what have we learned?
Yeah.
And what do we need to do different moving forward, which I think is a natural thing in the maturity and life cycle of a sector. So to me, I think that that's very, you know, promising, that I think there's some insights that's been gained over some recent decades. So I'm excited too for what the future holds, without a doubt.
Okay, any
Yeah, I would
last?
say, go ahead. I was gonna say, being asset management focused, I've been pretty excited about the innovation and technology I've seen for systems and such. People and process are always gonna be much more important and with us to stay, and fundamentally what seniors operations is based off of. But there's some pretty exciting stuff going on, and I'm excited to see where all that takes us as far as improving our product and resident care and just a better experience for and streamlining operations.
Yeah, I think everyone nailed it really well. Under promise, over deliver, right? I think we've come through a time where we've gotten humbled, but we have an amazing set of demographics in front of us and need. And so I think with all of that, I think we're getting pretty comfortable with. There looks to be a really positive trend in the future, and we're all excited about it. So a lot of need to fill, and we're gonna have to get creative, but very bullish on the future.
All right. Well, we'll keep talking and developing some creative ideas and driving that conversation. Thank you all for your discussion and your thoughts today. Thank you to the audience. We'll be sending you all a link when the recording's available so you can watch it again. Share it with your friends. And if you enjoyed this webinar, keep an eye out for our communications on upcoming MHN Voices webinars. Our next one is a broader topic. It applies to seniors as well as more broadly to multifamily. It's our mid-year investment outlook, and that will be on May 29th. And our sister brand, Commercial Property Executive, is offering a mid-year outlook, not just the investment, but again, overall for commercial real estate on May 20th. So do look out for those. Thank you again to everybody. It's been a really great hour.
Thank you.
All. Good being with.
Thanks, everybody.
Bye-bye.